Hey guys, welcome back. Drip Coach here with Drip and Farm for Poverty, where we don't trust, we verify, and operate with integrity and transparency. Today's video decided I would give you guys a taste of getting the info straight from the horse's mouth. So this is going to be a clip, only 3 minutes, won't bore you with all of the details, but a clip from Jerome Powell as he spoke about the interest rates last week and why he was unwilling to cut rates. I told you guys in an earlier video, showed you the jobs data and how those numbers are basically just falsified just to push a narrative. My personal humble opinion is that they've been pushing the positive side of it to push whatever Team Trump agenda has. And now that Powell is not playing ball with cutting rates, all of a sudden the jobs numbers are bad. So I think it's all part of the narrative to get him to cut rates. That's really all it is, in my opinion. The numbers don't matter at all. They're all made up. But all that really matters is what's the end result? What's the action that is going to happen? And then how do we respond to that action? So let's listen to Powell talk about this before the jobs numbers came out. And he explains the Fed's dual mandate in case you were not aware and don't know how the Fed works and what their job is in regards to balancing the risk between rates and the job market. So let's take a listen.
See it through.
And just follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like Treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, but then that'll be the case even after.
Real quick, just to summarize this, it's all, government speak. The reporter asked, how do you justify basically everything that's going on with the fact that people can't afford houses and the way that the current rates are? And Powell's like, hey, we don't directly, have any say so on the housing market rate prices. We have an effect, but it's not my problem. Basically is what he's saying. It's like kick the can down the road. It's somebody else's fault. I do a little bit, but ultimately there's so many other factors. It's not my problem. But that is one of the cases that I brought up multiple times as well, is that, yeah, people are finding it harder and harder to buy a home. Probably do a video on that in the future about the cost of our average home and how much of your yearly salary that takes to acquire a home now compared to what it used to take.
After things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment. And
there's that dual mandate, 2% inflation and maximum employment. And remember, Jeff Booth, the natural state of a free market is deflation. Where did this 2% number come from? Remember, in order to believe that that is necessary, you have to then accept the fact that you need someone to steal 2% of your wealth every year. Like, why is 2% the number? Why not 1.5? Why not 1? Why not 0? Why not 10? Some magical number, 2%, means that someone else is in charge, and every roughly, I forgot how many years, it's about 21 and a half years, you lose 50% of your buying power with that 2% inflation. And then when we actually take that up to the more realistic 5 to 7%, at 5%, you lose it in 9.5 years. And at 7, you lose it in about 6. So that means 50% of your buying power in anywhere from 6 to 20 years, depending on what that actual inflation rate is. And it's probably even higher than that. But remember, that is engineered. That is part of the system. So that they can steal your economic wealth buying power from your future and your children, if you have those. That is crazy. But like you just mentioned, they are focused on this positive jobs data and 2% rate. which is going to come into play because remember I showed you guys that the jobs data just shit the bed purposefully, in my humble opinion.
That's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation.
Very good labor market. Well, he found out literally a day or two later that there's like 270,000 jobs that were just wiped off the board between May to July. So the labor market is not as good as he thought.
We were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
So again, this job market idea comes up from another reporter and reviewer. I'm not sure who exactly these people are, but it's being mentioned yet again. He's like, well, what do you need to see? And ironically, all of a sudden, like I said, 2 days later, 1 day later, we get one of those things, the jobs market being weak as shit. Here's that article by Politico. The government now estimates that unemployment only increased by 33,000 total over the months of May through June, 258,000 fewer jobs than previously estimated. So it's like, yeah, what do you need to see? Well, maybe you need to see that the jobs market is bullshit and it's worse than before. So here's the numbers if that's what you need. So now you can cut rates. That's what it feels like to me.
I mean, ultimately, it could be any of those things, right? But you know, if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So you know, that was a time when policy was restrictive when we paused.
So now he's finding out that the jobs market has not been good because all the numbers have been fabricated, and now they're shifting to numbers that will again support a rate cut.
And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? You know, it'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? You know, it's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess.
So I'm calling the Babe Ruth shot that, yeah, they're just going to get more jobs data that says the jobs market is worse than expected, which obviously will signal towards cuts. And again, that just means money printer go burr. And this is the piece de resistance that the entire kind of risk on assets have been waiting on. We're still seeing an amazing bump. I showed you guys that in the charts. Remember, BTC is up already, literally a 2x from like August last year. Let me see. I still have that here. August. There we go. August. Let's zoom in so you can see it for yourself. August 5th-ish, right there. We're sitting at 58,000. So we're already up 2x from last year. So we are clearly in a bull run, even though it may not feel like it because we've had a lot of grinding and consolidating. But remember what I showed you from Plan B, and I'll have a video probably coming from him later on this week to see where we close the month at. Actually, I can pull that up myself. Let's switch this to the monthly. We should have still ticked higher. Yeah, we did. So the month of July closed higher than June. And here we are now in August. So everything is still in a bull market. It just may not feel like it because we have these 2 to 3% corrections. And it seems like BTC is just hugging this channel, which to me, again, is a blessing in disguise. So stay humble, stack sats, and don't worry about the rest of it. Like I said, BTC is just waiting for liquidity. That's the thing it only cares about. Yeah, we see some slight dips, you know, but it is par for the course. And those dips are getting smaller and smaller. Like even with the weak jobs data, it ended up being like a 3% correction in total. Like really, that's what we're screaming Chicken Little 4%, you know, in BTC. That is not a big deal. And if you're dollar cost averaging, like you wouldn't even notice. All right, let me know what you guys think. Smash that HBO special, help brother out, like, subscribe, comment down below. And until next time, live daily and achieve your impossible.